Imagine a world without cash, no coins jingling in pockets, no bills folded in wallets. Today, swiping a card or tapping a phone feels normal, but this transformation didn't happen overnight. Behind every credit card lies a story of power, trust, and temptation. It all began with one simple idea: buy now, pay later. A phrase that sounded liberating, but would forever change the way humanity spends. In the early 1900s, cash and checks ruled the economy. Stores depended on customers paying immediately. Then big retailers and gas companies noticed a pattern. Their best customers often came back with no cash on hand. So they created the first charge cards, small metal or cardboard tokens that allowed loyal clients to buy on credit. Companies like Texaco, Sears, and Bloomingdale's pioneered these cards in the 1920s and 30s. They weren't universal, each worked only within a single store or chain, but they introduced a radical concept: trust as currency. The true revolution, however, began in 1949 in a New York restaurant. Businessman Frank McNamara realized, to his embarrassment, he'd forgotten his wallet at dinner. That moment sparked an idea. What if you could pay without cash, accepted by many merchants at once? A year later, he founded the Diners Club Card, the first modern credit card. It was made of cardboard, valid in 27 restaurants and hotels, and bills were paid at month's end. Only 200 people used it at first, but within a year, thousands joined. The world's first universal credit system was born, money transformed into trust. In 1958, Bank of America launched Bank Americard, mailing thousands of cards to citizens who never asked for them. It was chaotic but revolutionary. Suddenly, anyone could buy without cash and without realizing the consequences. Mastercard, now Mastercard, arrived in 1966, and credit cards crossed borders. What began as convenience became a symbol of freedom and power. But behind that freedom hid something deeper, a new kind of dependence. Because credit cards didn't just change how we paid, they changed how we thought about money. No more physical bills leaving your hand, just a signature. And that distance between spending and feeling opened the door to invisible debt. By the 1960s and 70s, credit cards were everywhere. Families built their lives on borrowed money: homes, cars, vacations, all powered by plastic. Carrying a gold or platinum card became a status symbol, proof of success. But banks discovered a deeper secret: debt, when managed correctly, could produce endless profit. Every minimum payment, every late fee, every balance carried meant money for them. This was the birth of the credit capitalism era, an economy built on lending. Growth no longer depended on production, but on borrowing. Millions began buying things they couldn't yet afford, and the system thrived. Then came the psychological revolution. In the 1980s, card companies turned to emotional marketing: rewards, miles, and exclusive perks. They weren't gifts, they were bait. Every bonus encouraged spending. Every delay in payment meant profit. Interest rates rose. Plastic became an everyday habit, not an emergency tool. And the easier it was to pay, the harder it became to stop. Money stopped feeling real. Studies showed that paying with cash triggers pain sensors in the brain. Cards don't. Swiping a card feels good to good. That's what banks learned to monetize. In the 1990s, the internet arrived. Credit went digital. E-commerce turned cards into the bridge between people and a new digital economy. Visa and Mastercard became global empires. They didn't sell products, they sold transactions. They earned a small fee from every purchase on Earth. They didn't make things, they made consumption possible. Money stopped being paper, it became a flow. And credit cards became the highways carrying that flow. Behind every click and every purchase was a complex network of algorithms and invisible charges. And over time, the line between convenience and dependency blurred completely. Today, more than 3 billion credit cards exist worldwide. In the US alone, card debt exceeds $1 trillion. Most people believe credit equals purchasing power. In truth, it's one of the most sophisticated forms of financial control ever invented. Cards promise freedom, but they demand obedience. They promise flexibility but enforce discipline, the discipline of paying every month, with interest. Over-indebtedness isn't an accident, it's a design. Everything in the system is built to keep you spending: notifications, bonuses, zero-interest plans. Each is part of the same language: stay inside the game. Credit cards offer real advantages: security, rewards, building credit, but only if used wisely. They are not enemies, but they are not neutral either. Those who don't understand their rules end up financing the system with their own future. Responsible credit means knowing that not everything you can buy, you should. It means paying in full, not minimums, using credit as a tool, not as income. Every swipe is a small loan, not a victory. Credit cards reflect our relationship with time. They let us advance pleasure and delay pain, a dangerous luxury. Because credit doesn't measure wealth, it measures self-control. Real freedom isn't having more credits, it's needing less. The story of credit cards reminds us that money changes form: metal, paper, plastic, now digital. But the truth stays the same: whoever understands the value of time understands the value of money. So next time you swipe your card, remember, you're not just sliding plastic, you're signing a contract with your future. If this story gave you a new way to see money, don't let it end here. Subscribe to Let's Talk About Money, hit the like button, and share this video. It costs nothing, but helps us uncover the truth behind how money really works. Because understanding history isn't just knowledge, it's financial power.